We are very excited to have Mr. Kuben Naidoo join us. Kuben is a Deputy Governor at the Reserve Bank, the South African Reserve Bank. He is also the CEO of the Prudential Authority. And I was particularly excited at the prospect of having Kuben address us because of the fact that, you know, when the crisis first hit, there was a lot of initial concern that, you know, this crisis has the potential to be another 1929, 1930s type depression. And the reason for that is just the sheer fall of the market, you know, the quickness with which the market fell and the extent to which the market fell. A lot of the parallels were going back to that 1929 crisis. And there's this coming economic crisis that's still unfolding. And I think a lot of people kind of drew those conclusions that we're looking at, you know, 1929s, 1930s type depression. And I think very important that people understand that at a macro level, at a country level, at a high level, you have two critical policies that governments can use to help steer an economy through a crisis. And those policies are monetary policy and fiscal policy. Fiscal policy is simply government spending. You know, how does government collect taxes, how they spend those taxes. And so when we talk fiscal policy, think about Tito Mboweni and that budget speech that he makes in Feb. And then monetary policy is dealing with factors like interest rates and, you know, inflation, the currency, and the flow of money in the economy. So the reason we're quite excited about having Kuben is that Kuben has experience in both. He currently works in a monetary policy kind of capacity, but he also has experience having been in charge of the budget office at National Treasury, having worked in the UK budget office as well for a stint. And the third leg of kind of what was important or played a role in that 1929 crash was, you know, the fact that you had a lot of banks collapsing. Banks had been lending money out to people to buy shares, and with the crash in the market, those shares were now worthless, and you also had a banking crisis. So Kuben, that kind of uniquely left you as the key person that we were hoping to speak to, and we were very, very glad that you had agreed to talk to us. In that you can, you know, assist us in kind of looking at these policies as they're being made, and give us a sense of just the reserve, the role that the Reserve Bank plays, and all of that. So with that introduction, Kuben, I'm going to hand it over to you.
Thank you very much for inviting me. It's an honor. Let me start off by saying that South Africa has gone into this COVID crisis not in good shape, right? I mean, we had a technical recession. The economy was contracting even before we had COVID. We had a budget deficit in the February budget speech of over 6% of GDP. But it's not just a short-term problem. For 10 years, we've grown at an average of 1% a year. Right? So since 2010, 2011, we've grown at about 1% a year for 10 years, with the population growing at about 1.4, 1.5% a year. And so a lot of our buffers were, as a country, were not as healthy and as sound as it should be. And then COVID hit. Our initial view of COVID was that this is going to be deep, extremely deep, but it is likely to be about a 3 or 4 quarter problem. Right? That in 3 or 4 quarters, the world economy will broadly be up and running again at that stage. So this is sort of February, March At that stage, our view was that um, it's going to be a very deep recession, but a vaccine would broadly be available around the end of the year. By March, April next year, the world is vaccinated, everything is back to normal. And so our policy response in some ways was targeted at what they call a V-shaped recovery, a very deep recession. We knew from fairly early on, from data from Italy, because they were about 5 or 6 weeks ahead of us on the infection spectrum, that the negative GDP impact is likely to be even bigger than the Great Depression in 1929. But we certainly were of the view that it'll be a shorter crisis. For two reasons. One is it's a virus, it doesn't destroy physical infrastructure like a war, and the financial sector is in pretty good shape going into this crisis, and therefore we'll be able to manage the crisis. Financial markets went into absolute meltdown from about the 24th of February, with the bottom about the 16th of March, and by the 24th of March, it was pretty stable again. And it went into meltdown. I guess in some ways financial markets always overreact. There's a huge degree of uncertainty. Nobody quite knew what was happening. Nobody quite knew what the scale of the impact was going to be. So people sell everything. I want to give you a little bit of an anatomy about a financial crisis, a financial markets crisis in South Africa. So everybody wants dollars. Why? Because, well, I'm unsure. So I want dollars, right? I want dollars because it's a safe haven. I trust the dollar. And so everybody wants dollars. I've got to pay for imports. I don't know when I'm going to get the dollars. So you want dollars. People just want cash. Cash is king. Cash is certainty. I had a conversation with the CEO of a very large multinational paper company. He said, look, I've got a 1-year fixed deposit at the bank that earns a nice, healthy 7%. I'm converting that into an overnight deposit for 1% that yields 1%. So I said, why? He said, I want to make sure I've got access to cash. If I need to pay staff, if I need to pay suppliers, I don't know what my cash flow position is going to be. So cash is king in a crisis. But even if you don't want dollars, you still want rands. So where do you get rands from? You sell your assets, right? So you sell government bonds or you sell stocks in order to get rands. Or you go to the bank and you take up your credit lines, right? You tell the bank, I've got a 2 million rand credit facility with you. I want the money now. So everybody wants cash. And because there's a desperate need for cash, you don't care about the price that you sell your equities or your bonds. So you have a big fall in equity prices and bond prices. Now, unstable financial markets is something central banks know how to deal with. We've been dealing with it for over 100 years, and we're actually pretty good at dealing with it. So within 3 weeks of the crisis globally, we were able to solve the problem. We were able to provide enough liquidity to the market to satisfy the market that don't worry, there's enough cash in the system, don't stress, don't panic, stop selling at stupid prices. Now, of course, the US Federal Reserve did most of the heavy lifting. They have a balance sheet in dollars. They can issue dollars, we can't. But we issued rands into the market. Normally, in South Africa, we create an artificial shortfall in the money market of about 56 billion rand every day. So we drain liquidity from the market. From about the 17th, 18th of March, we actually were injecting a net amount of about 15, 20 billion a day. So that's quite a big swing. Essentially, we were flooding the market with rands to try and satisfy people that there is enough rands in the system, don't stress. And because of those actions globally, by the Fed, by the ECB, and domestically here, markets were actually pretty stable by the 24th of March. Some people would argue that the JSE is back at pre-2020 levels now. The New York Stock Exchange is back at record levels. Some people will argue that it's actually a little bit overdone. Um, you've got to take the nuances into account. Tech stocks are doing well, banks and retailers are not. But I'm certainly not an equity market analyst or advisor or expert on that. The second thing that so that was the first thing we had to do, right, is to stabilize financial economy, that people in good standing can get access to credit, that customers in good standing can get debt relief, payment holidays, loan restructures from their banks. Now, in banking regulations, if I miss one payment, the bank has to sort of raise a flag and raise a little bit of a provision. If I miss 3 payments, they've got to raise more of a provision. If I miss 3 payments, they actually got to start keeping higher capital requirements. If I miss 6 payments, they've got to keep even much higher capital requirements. Even if under normal circumstances, if I walk into a bank and I'm in good standing, I've never missed a payment, and I tell my bank, I'd like to, I've got to go for an op, and I'm going to be out of work for 3 months. Give me a 3-month payment holiday. The bank is forced to A, report it to us as the Reserve Bank as what's called a restructured loan, and B, they're forced to keep higher capital requirements. Now, if a bank has to keep higher capital requirements, it means that there's less money for lending into the economy. The bank has to effectively hold more money back every time it does this. So we then, in the 3rd week of March, 4th week of March, we amended the banking regulations to allow banks to provide payment holidays and loan restructuring without attracting higher capital requirements. We then lowered capital requirements. We lowered liquidity requirements for the banking system. We provided a significant amount of what we call prudential relief to the banking system to enable them to continue to lend to their good customers and to continue to supply credit into the economy. That's worked to some extent. I think the situation would have been far worse if we haven't. You still have a negative hit on credit and on the economy, but we think that that largely worked. The third phase was then saying, okay, but how do you get additional credit into the economy? If I'm a restaurateur and I'm closed for 3 months, it makes sense for me to keep some of my staff on pay, even at half pay. It makes sense for me to keep my gas suppliers on board, pay some rent, etc. And so we then, together with the Treasury and the Banking Association, started to develop. Take-up was quite low, but it's increasing fairly steadily. It's a learning curve, right? And our objective is to try and get some credit into the economy. Let me end off with the following statement, that I started off by saying our initial view was that this is a very short, sharp, deep contraction. Let me give you a sense of how we see the economy today and the next 2 years. So if we were, The Economist ran an article called The 90% Economy, and so I'm stealing some ideas from there. If we were making 100 widgets a month in January and February, we think in April we made about 60 widgets. We think in May we made about 80 widgets. In June, probably about 90, and in July, probably about 92 widgets a month. Our view now, so you'd think, geez, 92 widgets a month, that's pretty good. But remember, 8% of GDP is a lot, right? It's about 1.6 million jobs. It's informal sector. It's 1 in 12 firms, right, that won't survive, or not surviving, or not getting much income. Our view now is that we may only get back up to 100 widgets by the end of 2021, maybe even early 2022. So this is not a 3-quarter problem. This might be a 10, 12-quarter problem, where we will slowly get up to 100 widgets. There might be some wobbles along the way, some steps backwards, but we will move upwards back towards 100 widgets. But it might take 2 to 3 years to get back up to 100 widgets. And that has very devastating implications for jobs, for the kinds of income that people earn, for the shape of GDP, for tax revenue, etc. Because, economies need to grow to keep people employed. Standing still doesn't help, and going backwards by 8% is a disaster. And so our view is that we have to now recalibrate our of the hole that we're in, and there might be some steps back along the way. Our fear is that companies start to see 90 or 92 as a new normal, which means I must cut costs, right? So every firm in the country is saying, okay, new normal is X, I've got to cut Y costs, let me start cutting. So for the first 3 months, they kept jobs, they kept people going, but now they're starting to cut jobs. And that might cause a round of questions, Craig.
Great, Kuben, thank you for that. I think really kind of sets the scene nicely for the discussion. Something in there that you mentioned was part of your base case was that we should see some kind of vaccine by kind of December with the rollout globally. It's kind of March, April next year.
Yeah, look, our view has changed on that. I think we're much more pessimistic.
Because I imagine that a lot of your outlook is based on the timing of the development of a vaccine, the discovery, the testing, that whole entire process. And, you know, how reasonable is that assumption? I mean, have you kind of changed that assumption, and what has been the impact of that particular assumption in terms of...
You know, I think with the vaccine found this year and rolled out early next year, the global economy could largely be back at 100 widgets a month, you know, by middle of next year. But that is a pretty unrealistic assumption from what we know now. And let me also state that we're learning more about this virus every day, every week.
Yeah.
You know, there's still a lot that we don't know. We're still learning about it. From what the epidemiologists are telling us now is that it will take, you know, somewhere between 12 to 18 months to develop a safe vaccine. And it'll take about a year or two to roll it out to the planet after that. So, you know, you're looking at a fairly long process, a 2 to 3 year process, effectively. Whereas, you know, 3 months ago, 4 months ago, I was thinking, well, this is a 1 year problem. Now you're looking at a 2 to 3 year problem.
Okay. So in terms of your kind of back to 100 widgets, then that's 2022 kind of globally. How far does South Africa lag behind whenever that vaccine, because that's one of those unknown factors?
Let me, I'm no epidemiologist, but the scientists that I have spoken to say that it's not a quick process to develop a vaccine, and it's not a quick process to get it to 7 billion people on the planet.
Yeah.
The world has never done this before. I think after the MERS storage, and was never ever used, but it took about 2 to 3 years to do that.
Sure.
So we don't know, right?
Okay.
What I am told is that there are companies in South Africa and on the continent that are gearing up to go. So South African pharmaceutical companies are saying, look, we're waiting, we're ready. Active pharmaceutical ingredients are produced, etc. And of course, there's going to be a lot of nationalism at stake here, right? The US has already said, we will buy any vaccine first. And once we've produced enough for our citizens, we'll then allow our companies to export. Europe have effectively said the same thing, that they'll ban exports. And the biggest pharmaceutical companies in the world are based in Europe. India is the largest producer of generic drugs in the world. India produces 60 to 70% of all generic drugs. India said, they said, you know, when a vaccine comes, we'll produce. When we finished our 1.2 billion people, we'll start exporting. So, you know, for the African continent, I think we're going to have to gear up as well to try and produce that. On the economic recovery, Yeah, I think it's a 2 to 3 year period out. The fact that we've not gone in a good shape will lengthen that recovery. So the capacity of the fiscus to respond for a 2 or 3 year period would be weakened, is weaker than it would otherwise be. I think that's a headwind. Private sector investment has been weak for 5 years. Is it going to flick a switch and all of a sudden, turn positive next year? I doubt it, right? I mean, many of the underlying political economy issues that have weakened and undermined private sector investment over the last decade, maybe not the corruption element, but certainly the economic policy elements, are probably, people are still going to adopt a wait and see attitude. I do think that South Africa is in for a difficult 2 or 3 year period. There are many factors that would influence the recovery. The global economy is only one of those factors.
But I think let's come back to kind of your role at the Reserve Bank and look at particularly the issue of interest rates, something that everybody is interested in. I think those earning income fear that another interest rate cut would certainly make life quite difficult for them as they rely on that interest income. And then those of us with bonds and credit cards and vehicle finance would welcome another 2.75%, if you don't mind, which is already. So I just wanted to see, where do you guys see the path for inflation and interest rates, and how are we looking in terms of that interest rate? So are we at the end? Are we nearing the end? And how do you balance between keeping some powder dry in case this thing goes on a bit longer?
Look, Craig, for a fuller answer to that, I think you're going to have to wait. Is it 2 weeks? I think the 23rd of July, we make our next interest rate decision public. But let me state the 2 or 3 things that would influence that. In the short term, there's not much inflation risk. Right? In the short to medium term, inflation is more likely to undershoot the target than overshoot the target in the short term, in the 6 to 8 month horizon. Right? In fact, our official projections is for CPI to be below 3% for about 7 or 8 months. The July petrol price was probably slightly higher than we would have anticipated. But broadly, when we released the monetary policy statement in May, we projected about 7 or 8 months of below target inflation. Right? So that's the first point. The second round effects of inflation in the next 2 or 3 years will depend on 2 things in the main. Right? I think it will depend on the currency in one respect, but I think it will also depend on the pace at which investors have confidence in the government bond market. If investors, both local and foreign, are not able and willing to supply the government with bonds, you may well have a weakening of the currency. You may well have, if the government can't finance the deficit, it will put the country in a very difficult position. And I think that would introduce some inflation risk. Right? So I think that those are the 2 issues to watch over the next 2 or 3 years. On how close we are to the bottom, I don't want to make a call. I think different members of the MPC would have different views. But I think there are 2 or 3 debates. One is there room for a little bit more interest rate cuts? The second question is, do you want to keep some powder dry for later? Some people will argue, yes, that makes sense. Others will argue, no, use your ammunition now to support the economy now. It will be too late later. So those are the 2 sides of that argument. I think the more intellectually interesting issue is whether we can keep interest rates low for a long period during the recovery. And so I think we actually are pretty close to the bottom in terms of interest rates. Some people may think it can go a little bit lower, but I'm not quibbling about the 1/4 percentage point. I'm talking about in general. I think we are pretty close to the bottom. But if inflation stays low and the bond market and the exchange rate broadly stays stable, I think that will provide a basis for the central bank to keep interest rates reasonably low for a long period to support the recovery.
I think
the interesting challenge that we have.
Yeah, I think one of the concerns is that we have very high real rates. So interest rates are kind of 7.2 and inflation's at 3. So those real rates suggest, that we don't have accommodative policy, that we shouldn't have real rates this high in the crisis that we're facing.
Yeah. Look, that's true. The repo rate is lower, of course. The prime rate is higher. And so while most of us would borrow at the prime or higher, in theory, corporates should be able to borrow at lower rates than prime. So the real rate shouldn't be as high as that for everybody in the economy. But also, we try and take a 1-year forward view. So in general, we do not think that inflation will be 3% in 1 year's time. We think it'll be closer to 4 in 1 year's time, maybe even 5. And in 12 to 18 months' time. So on a forward-looking basis, interest rates are, at least the repo rate is negative in real terms on a forward-looking basis. But yes, if you take the inflation rate today versus what you're paying as a bond or what I'm paying as a bond, it would be above inflation. I think you've got to look at it in historical terms. This is the lowest that nominal interest rates have ever been. Right? I think the second factor that you must notice is that for every crisis for the last 60 years in South Africa, when there's an economic crisis, the central bank has put up interest rates.
That's right. Yeah.
This, like we did in 2009, this time we can cut interest rates in an economic crisis. Right? If you look, the history of South Africa is whenever things are going bad, the SARB is hiking. In 1998, the currency crashed, the SARB hiked. Asian crisis hit, currency crashed, the SARB hiked. 2001, currency crashed, the SARB hiked. Right? This time, currency crashed, we cut rates. And we can do that because of the track record that we've built up on inflation. So yeah, I'm sure there'll be people who'd like lower rates. I'm a bondholder too. But in relative terms, I think we've done about as well as we can.
Last question from me before we start tackling some of the questions that are coming through. And I think just to encourage everyone on the webinar, if you want to send a question through, please do. We're going to get to those in a few minutes. Kuben, you've been in the media this week, having picked a fight with a number of economists. And I think what those economists, if I understand their concern around kind of fiscal policy, where, it looks as if, government and treasury is cutting back on spending, and with corporates cutting back on spending, consumer confidence at pretty much an all-time low. Generally, if government is not spending in this crisis, who's going to do the spending that's going to cause or lead to some kind of economic recovery, or at least some level of economic activity? I understand your perspective in that, we're staring at an Argentina type scenario where we'll simply be in a position where we can't afford our debt, or everything, all other spending will be crowded out because of the amount of debt that we have. Can you give us a sense? I see where the economists come from and understand your point. Given this crisis that we're facing, where's that balance? Where's that in-between point?
Thanks, Craig. So let me start off by saying that in a crisis, it is absolutely correct for government to spend money. It is absolutely correct that the deficit will rise. There's no dispute about this, right? Government in the February budget planned to borrow 365 billion rand or something like that. We now plan to borrow 709 billion rand. Right? That's not a small amount. Now, yes, some of that is lower tax revenue, but some of that is increased spending. Right? The UIF money is increased spending. The social grants is increased spending. The extra allocations to health is increased spending. The payment holidays to companies for skills levy and UIF is a spending, right? And so government is spending more. Where I disagree with those economists is in two respects. The first is that they say we must spend even more. I would love to, but do you have the capacity to borrow even more? That's the issue, right? You're borrowing this money at 10, 11%. Government long-term bond yields are, 9, 10%. Let's call it 10%. You're borrowing 700 billion rand at 10%. You must pay the 70 billion rand a year just for this year's borrowing, right? For the next 10 years. Then you must pay back the principal. And so I honestly don't believe that we've got the capacity to borrow much more. I think we'll hurt ourselves if we borrow much more. And I think we'll actually delay the recovery. So it's not a question about whether we must borrow more and run a bigger deficit now. I think it's about the degree to which we do it. The second debate that I have with the economists is about the pace at which we reduce the deficit after COVID. Nobody is saying try and cut spending now. Nobody is saying that government must shut off the taps now. That's not what we're saying, right? And the budget calls for big increases in spending. I think that's right. Right? It's about what pace at which you reduce the deficit over the next 3 to 5 years. Right? And I think that we must learn a lesson, not just from other countries, but in South Africa. We went into the financial crisis in 2009 with a budget surplus of 1% and a debt to GDP ratio of 22%. We could afford to spend heavily. We ran a 7% deficit in 2009, about 6% in 2010. We were helped with the World Cup a bit, but actually the economy had fully recovered by 2011. But we didn't cut back on the deficit. So we were back at 3.5% a year GDP growth by 2011. We'd recovered all the jobs we lost, but we were still borrowing 5-6% of GDP in 2011. So we went into this crisis with a debt to GDP ratio of 65% and a deficit of 6.3%. After the crisis, and I'm not saying we must do it now, but after the crisis, there has to be part of the social compact of spending more now must be to say, well, I can't run deficits of this order of magnitude going forward because I will crowd out private sector investment. Interest rates will be so high that nobody else will be able to borrow, only government. And you can't get growth like that. So the two arguments that I've had with those economists are about degree. They're not about how much we spend. They're not about the fact that we should spend more. They're about how much more. And we all agree that we must reduce the deficit going forward. It's the pace at which we reduce it. I think that the budget is broadly right. They think we must be even slower about it. So it's not about government cutting back now. People say we've had austerity budget. Real spending in government's gone up 4% a year in real terms. 10 years, at a time when the economy has grown at 1% a year for real terms. Public sector salaries have grown by 5% a year in real terms for 10 years, right? Which means on average, everybody else in the economy got a 1% real increase. Public servants got a 5% real increase. Now, I love the public servants. I'm a public servant myself, but you're robbing Peter to pay Paul, and that's not sustainable.
there are no answers almost. We've got to manage our way through the crisis. We're getting a lot of questions coming through on kind of interest rates. And I think one of the questions, which I think kind of ties into what you've just been talking about, that gap between prime and repo, can that be lowered in any way? And, would that not also, if interest rates were lower, would a lot more company projects become net present value positive? Because the discount rate and the risk-free rate is a whole lot lower. And I mean, we see companies, we have lots of clients as corporates as clients, and not too many of them are getting debt funding at repo. It's closer to prime. So, how can we pull that lever a bit harder on interest rates to try and stimulate that spending?
Look, there are two parts of that question. Right? The one is, is there room for lower interest rates? Again, in the short term, I don't think that we see inflation as a major risk, and we've cut interest rates by 250 basis points. Right? It is at an historical low. But there are medium-term risks to the economy that we can't be blind to. Right? And our view as a central bank is to support the economy, to stimulate growth, but to also worry about the medium-term risks, right? And we've got to worry about those medium-term risks in part because the public sector doesn't have the balance sheet to manage some of those medium-term risks, and so the central bank has to worry about those medium-term risks. If we have a longer crisis, a deeper crisis, the public sector doesn't have the balance sheet to provide more fiscal stimulus, but monetary policy can be accommodative for a longer period. Right? Those are the trade-offs. So, and I honestly don't think that the interest rate is the major determinant of investment. Right? I think you've got to get growth going. You've got to fix the conditions under which growth takes place. If you in the agricultural sector, the uncertainty around land reform, if you in the manufacturing sector, the costs of getting your stuff to port, the time it takes to get inputs from the ports or output to the port. If you're in the manufacturing sector and you're operating at full capacity and then load shedding hits, right? If you are a small businessman and you've got a kiosk on the corner, how many times a month are you robbed, right? And those are not sexy stuff to talk about, right?
Yeah.
How many companies battle to find the skilled labor that they're looking for? Because the schooling system is not producing it at a volume at which the economy needs. And so that changes your business models, that reduces your propensity to employ, right? It's quite easy to say, well, lower interest rates will solve all of those problems. I'm not arguing that interest rates don't have a role to play. I'm arguing that it has to happen within a context of fixing these other problems so that you can reduce the obstacles to investment.
Kuben, I've got a question here from Trudy Nichols on the issue of global trade. I think it's an important question given that, what we saw in 1929 was also, this issue of kind of nationalism appearing and trade reducing quite significantly. Her question is 90% of global trade is subject to NTMs or non-tariff measures, which are accepted as being trade restrictive pre-COVID, eliminating the distortionary trade effects of NTMs on our exports, and those of other SADC countries would increase exports by 10% pre-COVID, more so now during the pandemic. What policy measures and decisions is the Reserve Bank taking to advance this speedily? I don't know if you've got...
The short answer is that this is an issue for government policy. The Reserve Bank doesn't play any role in this area of policy. I would agree with Trudy that if we got rid of tariff and non-tariff barriers within SADC, it would be welfare enhancing for both sides of the border. You know, I'll tell you a story about Swazi sugar. So South Africa imposes tariffs on Swazi sugar to protect South African sugar growers. The sweet companies and the Coke manufacturers merely locate in Swaziland. And then we want to impose tariffs on that. And, you know, South Africa has had tariffs on Botswana's manufacturers. And I agree, I think lower tariff and non-tariff barriers, especially in the region, will be welfare enhancing for both countries. It will be able to get more goods and services from the region. At the moment, some of those things we import from Asia. But I think it'll be good for growth in the region too. So I broadly agree with Trudy.
Yeah. Coming back to kind of a personal finance issue, and great question here from Khomotso, is where or how do the prescribed assets debate and possible strategies feature in terms of, you know, whether we could be looking at prescribed assets. And I think just for the benefit of the audience, prescribed assets refers to, you know, prescription, where government says so much of your retirement annuity fund or your pension fund or your provident fund has to be invested in government bonds or certain specific projects, etc. Where do you see that debate on prescription?
Sure. In most cases, people are given a fairly decent return on the government bond. They'll be prepared to buy those government bonds. You don't have to force people to buy the government bonds. If I force you to buy the government bonds, you'll find a reason not to buy the government bonds.
Yeah.
Right? That's the first point. I want to tell people what the history of prescribed asset requirements are. So 1985, the apartheid government had a debt standstill. It couldn't finance its debt, it couldn't pay its interest. So it introduced prescribed assets. That was the first thing it did. It said pension funds, you have to buy a certain percentage of your pension fund, you have to buy government bonds. Right? Then, of course, government said, this is nice. They have to buy the bonds. I'll pay them a lower yield. Right? So the 1985 interest rates were around 17, 18%. The yield on a government bond was around 12%. So you were getting a 5% negative yield. Would you save under those circumstances? No, you wouldn't. Right? So the apartheid government structurally damaged South Africa's savings performance between 1985 and 1992. Structurally damaged it. And it's never recovered. Right? Now, we're a low savings economy. We save 14, 15% of GDP. At that time, we used to save above 25% of GDP. Why should the government take steps that will, again, damage our savings performance? Right? If I force you to buy government bonds and I give you a negative yield, right, you'd rather find something else to do with the money, but you won't put it in your pension fund. Right? And effectively, you'll end up consuming it because it's cheaper to consume it. Right? And that would be negative for South Africa's savings performance. So I do not believe that prescribed asset requirements work. I believe they will damage the structural savings performance of the economy.
I think two related questions coming from Francis, Fraser and Logan Watt around the issue of SOEs. I think Francis talking about, you know, the idea of the PIC, you know, kind of offering some sort of funding or investing in Eskom and the Land Bank and other SOEs. And Logan talking about, you know, the fact that perhaps we need to close some of these SOEs that just completely suck the fiscus and drain funds that could be spent more productively elsewhere, so that we wouldn't have to look at 80% debt to GDP in the face. What's your view there in terms of how we challenge that, particularly the kind of historical issue around SOEs and the attachment that they have to the taxpayer.
Look, I don't want to get involved in discussions on SOEs. In some ways, that's government's policy choice. But let me make 2 points. The first is that I do think that the major reason why we're in such trouble economically is because the fiscus has, to use Logan's word, sucked money from the SOEs have sucked money from the fiscus. Right? That means I can't spend the money on other things like housing or education or water. They're choices here. And I do think that that's one of the reasons why we're in such trouble. All pension funds buy government bonds. They've got no problem buying government bonds. All the pension funds hold Eskom bonds. The PIC is a pension fund, it holds Eskom bonds. There's nothing wrong with that. Right? I wouldn't force them to do it, but they do it voluntarily because there's a decent yield. Right? It's stable income, long-term investment. It's a good investment. The question that's got to be asked about is about the nature of the PIC. The Government Employees Pension Fund is one of the few defined benefit pension funds in the country left. A defined benefit pension fund says that your retirement benefits are determined by your exit salary plus inflation. So I used to be a member of the GEPF. Effectively, if you work for 42 years, you get 100% of your retirement, your last salary. And now I think they average it over your last 3 years of your salary. But let's assume I earn 100 Rand in my last 3 years, 100 Rand a year. And I've worked for 42 years. So, you know, if it's 35, then it's 35 divided by 42 times your last salary. And I'm being rough about these numbers. So let's assume that my last salary, final salary was 100 Rand, and I worked for 42 years. I get a 100 Rand take-home pay. I get a 100 Rand pension, and that 100 Rand goes up by 2/3 of inflation. Right? Now, I've saved a lot of money, and so let's assume that the PIC takes that money and they waste it. They blow it. They give it to friends and family. They invest it badly. They lose it. As a defined benefit pension fund, government has still got to pay me my pension at the rate at which is in the contract. Who covers the difference between the pension valuation and the amount that's owed to me? The government. So it's a bit like robbing Peter to pay Paul, to say, I'm going to take the PIC and I'm going to make the PIC put money into Eskom. If that money doesn't yield a return, then government's got to then subsidize the pensions. We are in the fortunate position where we are one of the few countries in the world where the government does not have to subsidize the pension of public servants. Why would we want to change that? This is a financial health. It's a positive about our country. So that's the point I would make about whether you force the PIC or other pension funds to buy debt in SOEs, etc.
We've addressed quite a number of the questions, but I'm acutely aware of the time. So Kuben, at this stage, I'm going to ask Kagisho just to come into the picture. I think we could go on talking for much longer. I just want to let everybody know that we have recorded the session and we will make the recording available. So,
Craig, if you don't mind, can I spend 30 seconds on just 2 questions that have come through on the chats?
Okay, go for it.
The first question is about, is the SARB conservative and why have we not done more? The role of a central bank is defensive, right? In some ways, we're the goalkeeper in the team. Right? Now, if your team is not scoring goals, don't shout at your goalkeeper. Right? Our job in the economy is a defensive one. We prevent things from falling apart. We prevent things from collapsing. We don't have the tools and the instruments to drive growth. Right? So I can take Itumeleng Khune and I can shout at him because the strikers didn't score, and I can make him the center forward. He's likely not, the team's still not going to win. So when your team's lost and you're walking off the pitch, there's no point in only shouting at your goalkeeper. If your team is lost because your goalkeeper is messed up, then you can shout at the goalkeeper. But if your team is lost because the people didn't put the ball in the net on the other side, there's not much point in shouting at the goalkeeper. That's the first point I want to make. The second point in response to one of the questions is, why don't we have a formal employment target like the US Federal Reserve? Let me start off by saying that we do take employment into account. Our mandate requires us to take employment into account. Right? South Africa's got a structurally high unemployment rate that can't be solved only with monetary policy. Right? Yeah. Let's forget about the unemployment rate. There's something called the crude employment rate, the number of people between the age of 18 and 60 that work. In 1994, when apartheid ended, 39 out of 100 people between the age of 18 and 60 worked. This is amongst the lowest in the world. By 2010-11, we got that up to about 43, 44. It's now about 41, 42. Now, Brazil is at 56, the US is at 76, China is at 75, India is at about 70, the UK is about 75, Greece is about 65. At 42, this is not a monetary policy problem. Right? And you can't solve it with monetary policy tools. So we do take employment into account. But if we only took employment into account, we would break the house down to catch the rat. Sorry, Kahisho, over to you.
Yes, Kuben. Yeah, no, thank you very much for that analogy. I actually quite like it. I just wanted to know, if you are the defense, who are the strikers that we need to get onto this panel next time so that they can tell us why they're not scoring the goals?
I think it's the things that drive growth, right? Education, quality of education. The DTI, your trade policies. Why do we have no 5G spectrum auctions 7 years after the president promised? You know, in the 2009 State of the Nation address, or maybe it was the 2010 State of the Nation address, President Zuma said we're going to be building a coal line from the Waterberg to Richards Bay. There's no coal line. Central Bank, we don't build coal lines.
Okay.
Why is there no coal line?
Fantastic.
So,
Kuben,
those are the people who will score goals.
Thank you very much for that. We as we said, we're quite keenly aware of the time constraints. We have come to 1 o'clock. So all I'm going to do now is just take this moment to thank you, Deputy Governor of the Reserve Bank, CEO of the Prudential Authority, Mr. Kuben Naidoo. Thank you so much for making time to spend time with us today. I think this session was incredibly informative. We can see from the comments that are coming through from some of our guests on the line. So on behalf of British Marine Investments and the guests that we have online, thank you very much for your time. I'd also like to take some time, Bianca, just to thank you and the team at Analytics, Zianda, for organizing the session. I think it's run a lot smoother than we thought it would. Thank you for your technological experts on your side. I also just like to make a comment on our ops manager, Cyril Chetty, who's taken a lot of time dealing with the logistics with you to put this thing together. And thank you, Craig, our host.
Thanks, Craig.
Nice informative questions. Last but not least, to our guests, our clients, prospective clients, our friends that have taken the time to come and be with us this afternoon. Thank you so much for taking your time. It's because of your support and your questions that this thing that we had this afternoon was as successful as it was. Thank you very much, everybody from our side. Thank you and good day.